Hey everybody, it's Chris Kirkpatrick with Life 180, and I'm here with Galen Nuttall from Canadian Whiteboard Finance. And today we're going to be talking about whole life insurance for Canadians, flexibility, rigidity, and just helping people understand and ultimately just have clarity around uh, the structure of whole life insurance and ultimately how it can be probably a little bit more flexible than people think of whole life insurance from a classical stance, right? And so I know this is probably something, Galen, that you get a lot of questions about with people that are reaching out to you that are interested in utilizing whole life insurance as an asset, for themselves, as a storage of value for their cash. But one of the biggest concerns that I know I get a lot from people who reach out from the videos that I make is they think that they're scared of committing to a certain premium because of the fact that they feel like if they commit to that, they need to commit to that. And if they can't meet that number every year, they're going to be in a lot of trouble. Their policy will lapse. They'll lose all the money they have in the policy, all these different things. So excited to have you kind of do the whiteboard thing that you do and kind of go through it, man.
Yeah, awesome. No, thank you so much for having me. And yeah, this is really in line with what I call this product kind of like the multi-tool of financial products. Like
Mm-hmm.
when I was a kid and I would go camping, I'd have this one tool that had like a knife and a screwdriver and like a can opener. And I feel like this product is very similar because it can be used in a lot of different ways, and you can really structure it in a lot of different ways.
Mm,
If an advisor knows what they're doing, they know how to use the software, and
sure.
so I think and definitely like when I hear people come to the table, a lot of the questions they do have is like, do I have to commit to that whole premium every year? Is the number of years set in stone? Like, really, people are looking for like, okay, what does this look like? And
Sure.
I'd say that like you said, like the classical way of structuring these things is like you're committing to 10 years, you're committing to 20 years. Like 20 is a really popular one
Mm-hmm.
historically in
Mm-hmm.
Canada. The 20 pay is just like a super popular historically one. Historically, like people use a lot.
Mm-hmm.
And then there's also like pay for the rest of your life is like the other one. So sometimes people look at that and they're like, I don't know if I can do that.
Yeah, totally.
So I set it up, and we'll go into it. I'll crank up the whiteboard, but basically I just structure it that it's just the flexibility is to the client's benefit as much as possible.
Okay.
In that, if things go great and they can do premiums for a really long time, they have that option. If
Yeah.
they end up wanting to condense the time frame, which a lot of people do, they've
Mm-hmm.
also got all the options. So I'll talk about like kind of the main ways that we can maximize the flexibility of this.
I love that because I love educating to this, people to this in the United States because it's infinitely more flexible in the United States than people realize. I'm not sure how it works in Canada, so I'm interested in learning like everybody else right now.
Absolutely. And yeah, and I mean, you made it abundantly clear that I am in Canada, but also feel like just making it like super clear because I have noticed an ad before the videos that's like, you're about to hear some guys that aren't in Canada talk about this. And I'm like, nope, I'm in Canada.
Oh, that's
So,
funny. Oh, that's hilarious. Oh, so
yeah,
so Canadians are marketing to Canadian channels just
absolutely.
because most of the content on banking policies or whatever is all by Americans, right? So,
Exactly. Oh yeah, there's an abundance of
gotcha.
content out of the states for
Oh, that's
sure. We're
fascinating.
starting to
Okay.
pick up in Canada, but yeah, no, just thought I'd point out I am in good old
Okay.
Canada,
Fair
licensed
enough.
across the country, so
Awesome.
we'll get ready to rumble here.
Cool, man.
Yeah. So really, when it comes to flexibility, like I said, like the classical, and I really like that word you used of classical. The classical way of structuring a one of these was that you picked a premium. So I'll talk
Hmm.
about premium over here, and you picked a time frame, and you really stuck to that. So I'll say like premium and time frame, and that was it. And like I said, the 20 year option was a pretty popular one. Like it has historically been like a lot of advisors just really like that 20 pay.
Hmm.
I think partially it gives people that confidence of like, oh, okay, I'm going to pay for this for 20 years. It's really popular among kids where it's like, oh, you'll be done. Your kid's born, put one of these in place, you're done paying in 20 years. The
Hmm.
downside to that is a lot of times I meet people who are like, well, I want to keep this going. Like, especially
Hmm.
once they see the value in it, they see the compounding inside of the policy. They're like, I actually
Totally.
don't want to stop. Can I keep going? And I'm like, no, like you contractually agreed to stop in year 20. You
Yeah.
can't actually keep going. So
In
I don't,
Canada, in
yeah,
Canada,
like
if they do a longer policy, can they do like a reduced paid up version? If it's longer, can they amend the policy at year 20 if they want to?
absolutely. Yeah. Yes. Yeah. So
Okay.
we have the reduced paid up option. That's one that people have to like request specifically. But
Yep.
yes, that's one way to reduce the length. And that option is always there. But one of the things that I do is like upfront, I structure it out of the gates to be as flexible as possible. And
Mm-hmm.
I'd say that like for the most part, when people structure it this way, the premium is pretty much locked in all those years,
Mm-hmm.
where they're going to pay the same premium every year for 20 years, no matter what, which I'm not going to say it's bad. Like if you've got one of these, not a bad thing. I think the first policies I put in place when I became an advisor, maybe I did them as 20 pays, like for myself. But
Mm-hmm.
then over time, I realized like, no, I want like the super flexible one. So
Okay.
this is 20 years. And so what I typically do now is I increase the flexibility on both sides of premium and on timeline. So, and it really comes down to what the person wants. Like people really come to me for two things usually, and it's really the two things that I can look for in the software. Sometimes people come to me and they say, "Look, Galen, I need like a really good death benefit." Like people who come to me, they're very aware of the estate bill that they're going to owe at the end of their life, whether they own a bunch of properties that are going to be taxed, or a bunch of investments that are going to be taxed, or a business that's going to be taxed. They come to me and they're like,
Mm.
"Galen, tell me what that tax bill is likely going to be, and then I'm going to see if I can fix that. Like put something in place now that the life insurance is going to swoop in and really help with that." Because when I meet with people, a lot of times people with companies or people with properties, I just say, you're going to have to go find, like, if you don't do anything about this, just pick
Mm-hmm.
what you're going to sell to pay the
Gotcha.
tax bill, because the
Yeah.
tax bill has to get paid. So what are you going to sell? What do you want your kids not to inherit that you're going to sell? And a lot of people say, well, I don't want to sell anything. I want them to get as much. Like I've worked really hard to build this business or this, like, property empire or whatever it looks like, or the investments they've saved, or, so they want to take care of it. So that's where I start with is like, what's the intent? Is the intent the high death benefit, or is the intent like the high cash value? So
Gotcha.
the way that I can structure this is, this is how I typically do it. I typically say, look, you can go all the way to age 100. So I make it flexible. So this kind of becomes a sliding sort of scale. So I'm going to get rid of this for a second, on the timeline. So I'll just say this timeline. So really, when I structure these people, they can either go like all the way to age 100, or they can offset this as early as like things will allow, which is usually like the standard offset, I'd say. So all these things depend on age, gender, like a lot of factors. But when I'm getting in front of someone who's in their 30s or 40s in good health, they can usually look at paying into this for about 6 years. So
Okay.
that's like the shortest, I'd say. Now,
Okay.
the cool thing about what happens when I make it shorter is it also adds a lot of flexibility to that premium. So when I talked about that premium being fairly steady, a lot of times what we look at is, if we're going to maximize the ability to offset, to stop paying for the premium out of pocket every year, it's also going to maximize the flexibility of the premium, because some of the premium is going to go more towards that early cash value. And that's technically
Okay.
something that if you want this thing to chug along and like grow and like keep up with the projected illustration in the early years, you're going to keep it going.
Mm-hmm.
But some people, when they get to this point, they can decide, like even along the way, they can decide, do I need to drop the premium down? Do I need to drop it down for a bit and then bring it back up to the full one? When they hit that offset mark, maybe they just keep the base going. Like there's just a ton of options when someone sets it up this way. And the beauty of it is it all benefits the person who's putting it into place. Like the benefit is earlier potential offset, earlier cash value, like more flexibility with the premiums. Like it's really positive all the way around.
Cool.
Now, what I'll say is, if someone comes to me and they are, so this is like, let's just leave this here. Like, I mean, this is, the timeline is for, let's say someone there's 40 or 50, so they've got like 50 years ahead of them. And like I said, they can decide to just keep going. Like they could just keep going with the whole thing, which I do see in cases. If someone's got investments or like a good cash flow from another spot, some people just want to keep this going. Like they don't want to stop it. Like I said, like people get to age 20 or year 20 and they say, I want to keep this going. Now, the cool thing is, like I said, the 20-year one, the traditional one, and I'm calling the 20-year one the traditional one. The
Yeah.
reason it was appealing was because people thought, oh, okay, like, I know I'm going to be done in 20 years. And because they were maybe nervous about doing it past that point. But the
Yeah.
beauty of doing it this way is they can offset way before year 20 if they
Okay.
need to or want to, rather than actually wait until that 20th year.
And
So
they
it's
can go
fun.
past your 20 if they want.
Yeah, the way I set it up, they can go all
Yeah.
the way from 6 to 100. Like this is
That's
their
awesome.
age 100 range.
Now, Now, is the premium they pay every year, like on like from past year 6, because you have 6 is whatever,
Yeah.
and then the line goes up and then it goes flat. So is the premium flexible every year in those years? Like
Yeah.
it
Yeah, it
is.
is flexible. So like basically, like I can draw this a little bit more and a little bit more. I'll expand it a little bit so it's really like clear. When someone picks that flexible premium, let's make it a little bit bigger so it's easier to see. Um, so premium. So this is the yearly deposit, right? Really, when you structure it to be as early offset as possible, quite like the base is kind of like, this is the base premium, and this is like the additional premium.
Mm-hmm.
And the additional premium helps with early cash value.
Mm-hmm.
So the way it works is, usually when I set these up for people, I say, look, like I really encourage people to set it up in such a way that they can commit to everything the whole 6 years. Like it's really going to be the best setup.
Mm-hmm.
But people do like to have the peace of mind. Like if I had to drop at any given year, so let's say this is year 1, 2, 3, 4, 5, 6, someone could drop down to the base if they needed to.
So that area between the base and the additional, that's all, so to speak, optional
Yeah.
premium that you can put in.
Yeah, for
Yeah.
sure. And we set it up from day one, like, because some and it's kind of funny because sometimes people ask me like, well, why can't we move this like way down here? And I'm like, well, I mean, the software, the legislation around life insurance and investments, like I can't drop it lower than that. This is so I
Mm-hmm.
always put it to the, usually when I'm talking to people and they're interested in that early cash value, we make the additional as large as possible and the base as small as possible.
Totally.
And yes, it is optional. Like, I mean, like I said, I usually set up for people like they're planning on paying it, that like whatever that projected offset, and it's all projected. Like it depends
Mm-hmm.
on the dividend scale and all that. But I mean, a
Sure.
lot of people, the projection is 6 years. I do like to have some buffer. Like I'm like, hey, if you had to do another year or two of this, could you? It's very unlikely they'd have to, but it's always just like a backstop.
Mm-hmm.
Or if they have to drop to the base, that's always like the backup is like if they have to go down a bit.
Totally.
Then they can keep either the full thing or the base going all the way to age 100 if they want to. Like it really depends.
Really?
Yeah, like sometimes, let's say someone sells a property and all of a sudden they've got all this cash and they're not sure what to do with it. They could keep paying the premium with that cash. Or someone sells a business. Lots of things happen where people suddenly have more cash than they expected. So it's really the most flexible as early as possible, or they can keep it going as long as possible.
Hmm.
The other thing I was going to say though is there is an enhanced version of this. So if someone comes to me and they say, Galen, I know that I'm going to have this like estate problem. Like, this is happening, I'd say, with business owners who are, 40s, 50s, they're building a business that's really booming. And so
Mm-hmm.
like when you like, this is one thing to understand, like when someone builds a business from zero, the starting value of that business was zero.
Mm.
And when that business grows to be worth 20, 30, 40 million dollars, like that's all growth of the business. Like that's all from zero to growth. And so at some point in time, when someone passes away, depending on how things are structured, someone's going to have to pay some taxes. And that's a big part of what I help with is,
Gotcha.
first off, working with like legal and accounting teams. What can we do from the standpoint of corporations and, like, I won't go into it in this video, but like estate freezes and like all these
Yeah.
fancy things.
Sure.
What can we do with that to help? But then also, where does this fit in? So I've had some young entrepreneurs come to me and they're like, Galen, like my business is booming. Like they've just picked a niche that's done really well. And they're
Mm-hmm.
like, I do want to make sure that I'm starting to work on this. And so if someone comes to me and that's their intent, we can actually run a special quote that can actually potentially move this down and can
Hmm.
actually increase the percentage that goes into the additional. So it can actually make it look more like, so the new base for those looks more like this. Like they can actually do something like this.
Can
Or
you front load a bunch of money and dump a bunch of money? Like if you had a $20,000 annual premium, could you dump 60,000 in the first year on top of the 20?
yeah, so you're not, I mean, the way you could do that in theory is to set up a policy with a very large additional optional spot, like, and then dump it in that first year, but then drop that additional. Like that's one way to do it.
Okay.
I always run the numbers because I want to know in the long run, kind of like what you're talking about, like, is someone going to be better off by dumping stuff in early,
Mm-hmm.
or are they going to be better off by spreading it out over time? Like I look down like 10, 20 years to see
Mm-hmm.
like, is the cash value going to be higher because of like option, if this is option A and this is
Yeah,
option B?
totally.
I always want to see which is better, option A or
Sure.
option B, because sometimes people want to do that or they want to do it earlier, and I really look at the long-term consequences of that, because sometimes people are like, oh, I've got this amount of money that I want to start putting into this. I just want to make sure that they're going to be happy 10, 20, 30 years from now that they did it the way they did it. So yes, there are options. Like I said, we can run a special enhanced optional premium version that may drop the base or increase the additional, that and it also reduces the number of years that someone has to pay. So it's very situation dependent, but it can be really good for someone who's like, I want to start taking care of this problem yesterday, let's get it going, like let's front end this, and it can totally work for the right person.
Nice. It's very, very similar to probably a lot different lingo and, all that stuff, but it's very similar to the way it works in the US. As far as that goes.
Yeah, companies are always looking at what other companies are doing.
For sure.
A lot of companies are owned in different continents by the same like top corporations, so they're all talking to each other. Everyone's always looking at what everyone else is doing, but the biggest difference would be the legislation of the country, right? Like if the tax code in Canada,
totally,
the you call it down there the was it the MEC?
The MEC limit. Yeah.
So up here it's called the MTR.
Okay.
So like
MTR.
Yeah, MTR.
What's that stand for?
Good question.
Okay.
Maximum taxable something.
Okay.
I always refer to it as the MTR.
Maximum taxable account regulation. I don't know.
We'll go with that.
We'll go with
the MTR line. Oh, it's kind of funny because when I was getting licensed,
restriction. Maximum taxable account restriction. I'm looking it up while you're talking.
Look it up.
You keep talking. I'm looking it up.
I looked it up the other day, but I say MTR so much that I don't look at anyway. Okay. So when I became an advisor, I remember like there was this dude that was teaching me, like he was kind of helping us get our licenses. So it was like this crash course of like cramming and then taking the exams. And he was he reminded me of like a back alley Brooklyn kind of like rough around the edges kind of guy. And like on day 2, he started telling us about the MTAR line, and he's like, don't you dare cross my MTAR line, because he literally said this. He's like, because I'm going to take you out to the shed and I'm going to shoot you.
Oh my gosh, that's hilarious.
I remember being freaked out. Like I'm new to I'm brand new to this. Totally. I don't know what he's talking about. I'm terrified. Yep. Like, am I going to have clients like kicking in my door because I crossed this MTAR line? And so it was pretty funny because he's like, don't you dare cross my MTAR line. I even wrote a poem about it and sent it to him because he had me having nightmares about crossing that MTAR line. All that being said, like funny. The software takes care of it.
Yeah. It protects you. Yeah. It's
like, I don't have to like pull out like a slide rule and like a financial calculator and an Excel spreadsheet. Like I just punch it in and it tells me what to do. But it was pretty funny because he had me with this notion of like, I'm going to make a mistake someday. I'm going to ruin this for somebody. And like, that's not how it works. All right, let's hear it.
So, okay. It's maximum. What is it here? Okay. Maximum tax actuarial reserve. Maximum tax actuarial reserve.
We had the MT right, but then the AR was way off.
Yeah. So what is the MTR rule? The 250% rule helps limit the size of policy payments to keep life insurance policy from becoming an investment. In the CRA's view, that could improperly grow on a tax sheltered basis. Okay.
Yeah. So
there you go.
Really what we're looking at here is all these things that we do, or that I do, to make these as flexible as possible. It's part of it is affecting like how the policy is reacting to that MTAR line, because the companies are not allowed to cross that line, right? Like,
it's government regulated.
It's government regulation. We're not allowed to cross that line.
Totally.
But all of these things are kind of moving it backwards. Like if an advisor doesn't know how to structure these properly, the MTAR line, like it's tough to put onto this graph, but just for illustration purposes, let's say it's like way out here. And they're like, yeah, you got to stick this out, this 20 pay, whatever. But then every additional flexible thing I add to it kind of helps move it that way. And to visualize it like I said, this is something that actuaries do. And these are people who just love calculations, but this is in essence what we're doing is we're keeping the policy under that line by adding the maximum flexibility to it. So it's all great stuff. Like a lot of When I became an advisor, I didn't fully understand this at all. There's a little button I have to click on my software to actually start messing with these numbers. And I was just really thankful I had a mentor in the business who sat me down and really, like, we were running all sorts of illustrations of, like, it's basically comparing policies like this. Like, you'd see policy A, it's like, does it look like this? Policy B, if you structure it differently, does it look like this? I mean, it's
Mm-hmm.
really cool stuff. And so I do that for my clients. Like, I look at basically 4 different options. Like, are they going to do A, B, or C, C or D, depending on like what they want. Like, it kind of like, is it like this? Is it like this? Like, it's good
Yeah,
stuff. So
that's
I
awesome.
mean, working, like I've I mean, I don't do it as much. Like, I used to run like literally 30 illustrations. Like, now I've figured out how to run like the top 4, and then in between those
Yeah,
there's some
it's going to
nuances.
fall into a certain window.
Yeah, for sure. And depending on what the person wants, do they want the early cash value? Do they want the death benefit down the road for estate planning purposes? What's the intent? And then that helps us structure it. But I will say that, like, at the end of the day, a lot of them end up being this over here, which is like, what's the maximum additional optional portion I can put in? I like it because it's really, like, it's just like protecting the client against anything that's unforeseen, to be
Sure.
able to say, I'm not committing to this for 20 years. I
Totally.
could stop in 6, 7, 8. Like, it just, and if someone wants to keep going, they can. But like, I just like, 9 times out of 10, this is how I'm structuring them to make them as flexible
Okay.
as humanly possible. So,
Perfect.
yeah.
Love it, man. That's awesome. So are Canadian companies like the United States with the MEC limit, where each company has its own interpretation of what that MEC limit might be, and they kind of take the algorithm, so to speak, or the mathematical equation that is the MEC limit according to the government, and they, you know, create different policy flexibilities like term riders and other different types of riders to make it so you can put more cash up front early or increase cash value compared to death benefit, all those different things.
Yeah, I will say that companies have different approaches to how they, yeah, I mean, they have different approaches on how they stay within the limits of that line.
Uh-huh.
And the word interpretation might be an accurate one. I mean, it's definitely like, they don't want to mess around, obviously. Like, they
Sure.
got a lot at stake. But yeah,
Yeah,
there's definitely from company to company, there will be some variations into how, what they've put into place to just see what they can offer from a
sure.
flexibility standpoint, while still
Yeah.
staying within the rules, for sure.
Okay.
Like, different companies
Cool.
have different ways of doing that. Yeah.
Rock on, man. Well, this is awesome. So guys, if anybody that has any questions about any of this, you can reach out to Galen. I'll put a link below in the description of the video here. He's a wealth of knowledge for you to help with life insurance, but with everything, honestly. If you're looking for any kind of financial advice, planning, anything in Canada, he's definitely somebody you can reach out to. And yeah, so that's pretty much it. Anything else from you, Galen, on this topic, or are we
No,
good
it
for the
was
day?
phenomenal. We
Rock
jammed
and roll,
out.
man.
I got to talk about something I'm really passionate about, and
Rock and
as
roll, man.
always, I enjoyed being on your show.
Rock and roll, man. Well, guys, have a blessed, inspirational day. Reach out to Galen if you have any questions. And as always, I'm here as well. There's a link below. You can reach out to me as well. Any questions? But until next video, we'll see you then. Later.